SilverCrest Metals is a Canadian precious metals exploration company with projects in Mexico's historic precious metal districts. SilverCrest is responsible for the most successful silver discovery in recent years and for finding some of the highest grades of silver on this planet. President of SilverCrest is Ritchie. He is a financial market professional with 15 years of experience in resource-based capital markets. Chris is also an avid sportsman. He holds national titles in tennis and played in the Canadian National Australian Rules football team. Ritchie takes us to Mexico with SilverCrest Metals.
Willem, SilverCrest was at the Discovery Day last year, so you gotta love this country. What's the story?
This company, it's the second company we have which is active in silver in Mexico. As we explained during the Reiner presentation and afterwards in the Q&A, it's quite rare to have a good silver discovery. They're real rare. As SilverCrest is it's a different company compared to Reiner Silver, because Reiner Silver still has to prove they have a silver deposit. And SilverCrest has been drilling their silver discovery for years now, and it is seen in the industry as the best silver discovery out there worldwide. And we love silver. The silver price is on a strong uptrend since March or April, May. And we love this project. So we wanted to bring it back because it's simply the best silver discovery out there.
Okay, let's watch their presentation.
Thank you, everyone, for coming today. We're happy to be here. It's a great conference. We do know this is a growth conference, so I know we're going to spend a lot more time on the upside that's still left in SilverCrest. Had a great time last year in Amsterdam. Unfortunately, can't be there physically this year. Hope to be back next year. So again, thank you very much for having us. SilverCrest Metals, for people that aren't aware, is a spinco. And a big part of our story is understanding our history in the Sonora Valley. So again, we're in Northwest Mexico. And a big part is that our CEO, Eric Fier, discovered, permitted, financed, built on time under budget, and then operated for 5 years a mine that was right next door to the current property that we're working on today. So a big analogy here is having a team in place that can execute and build a project. And then from there, we're going to talk about how we can continue to grow. We have a strong dual path structure and a dual path strategy. And that strategy is to continue to grow while we're building and moving towards cash flow. The Santa Elena project grew approximately 300% in resources after it went into production. And that's a goal we have for Las Chispas today. So we're going to walk through the base case of where we're at, and then we're going to show the defensive nature of where we're at, and then talk about how we can continue to grow at the same time. So just some high-level details here. We mentioned Eric Fier. At the same time, we've added a COO, Pierre Baudouin. He built the largest mine in Canada. So again, this project is probably, 5% or less in terms of size compared to that project. So in terms of the project management skills, the build skills, that's a huge add to our bench strength here. In terms of that base case story we talked about, we did put out a PEA about 8 months ago. And as you can see from that second row there, that we had an after-tax IRR on the project of about 80%. And that was still using a silver price at $16.68 and a gold price, obviously, as you can see, much, much lower there. And the payback was 9 months. Okay, that was only 10 of 43 known veins. The upcoming feasibility study that we hope to have out by the end of the year will have approximately 20 of a known 43 veins. So again, as part of the growth, it's important to understand of those 20 veins, only some of them have been fully explored. We have not fully explored the depth potential. We're working on that now. The other 23 veins we've yet to drill still have opportunity for us. And then we also made a new acquisition recently, which I refer to as Eric's new toy. And that's a project that could be within trucking distance if we're successful there. The balance sheet we have today, $154 million US. We will need more capital. We'll walk through some of those details. But at the end of the day, we're still very well positioned in terms of the balance sheet. The drilling leverage. This is a big part of the story here. We're one of the highest grade silver mines in the world. If next time anyone's in New York when we're allowed to travel, there are specimens from the Las Chispas project in the Museum of Natural History. We have data going back from 1880 to 1930 when this asset was historically in production. And the average grade back then was 3 kilos silver equivalent. When we put that in context, we have a chart showing that the top 20, 30 silver mines in the world, if you were on the outer edge of that range, if you had 350 grams per ton, it would put you in the top 20 or 30. So again, our grade is fantastic. As you can see right below the drilling leverage number of intercepts over a kilo, it's over 550. And then we have over 140 intercepts over 5 kilos, and then 63 intercepts over 10 kilos. Right above that, again, we see a number there that 40% of our drill hits are above that 350 gram a ton range. So again, that puts us in context of that pretty much 40% of our hits are within the top 20, the highest grade silver mines in the world. A number we're very proud of is our efficient use of shareholder capital. We've added approximately $9 or $10 for every dollar that we've spent. So we've spent 122, as you can see. We've spent about 80 million US in drilling alone. We have the upcoming feasibility study. In the PEA, we had 88 million ounces in the actual mine model. So it gives you a sense that it's roughly $1 an ounce if you use that May 19 study. In our PEA, it's approximately $5 per ounce of an all-in sustaining cost. So if you add the drilling plus the operating cost to get it out, you're still about 6% or about $6. And we'll go through that to show that puts us in the bottom 10 percentile in the cost curve. In terms of where we're at and progressing towards a re-rate, we will have 8 drill rigs, or we do have 8 drill rigs turning today. We have all of our major permits. We've been operating the valley for 15 years, so we do have a strong operating license. The capital requirements are quite modest, we're happy to say. And we do have a significant stockpile already on surface, and we already are mining. So again, a big de-risking event for us. Quickly here, the Las Chispas project, you see it in the middle. The Santa Elena project just below that. That's the one that, again, Eric took all the way from discovery to production. And then the El Picacho, again, that's 85 kilometers by road. Eric worked on a project at Newmont where they were trucking ore 350 kilometers. So again, that's well within range. Quickly on the capital structure and the financing, we discussed having the 154 million US in hand. At the end of the year, we expect to have approximately 110 million. We don't have the final numbers yet for the capital required, but we think it's in the ballpark of 130 to 140 million. So that would mean we'd have roughly a $30 to $40 million shortfall based on just the CapEx. On top of that, we'll have working capital needs, our G&A till the end of 2022. You're always going to want to have, $15, $20 million of insurance money just in case. And then again, we want to have a very robust drilling project. So if you add all of our needs together, it gets you approximately 150 million of additional capital required. If we were to raise 70 or 80 million US via equity, as you can see with the 129 million shares outstanding, the share price today is about 8.5. If we were to issue 10 million shares at $8 US, as you can see, it's probably about 7 or 8% dilution. So again, the capital structure is not sensitive to our needs. On the debt portion, if we were to raise a roughly 80 million on the debt side, we'll show the numbers here, but we think that at today's commodity price, and if we execute, that would be a payback of that debt well within 1 year. Our shareholders, first and foremost, insiders own a very significant amount. As you can see, insiders have purchased 6.1 million shares, including options. We're over 8%. So again, very material alignment there. On top of that, you do have a lot of the traditional precious metals funds in there. So hopefully that's validation for people that have yet to do much work on the name yet. So again, still working on the base case here. I'll highlight people to look at the top left of the screen, and that is the commodity price used to come up the numbers that we'll talk about. In the middle column, you'll see, if you kind of scroll down there, you'll see the first number, which is the average grade of silver equivalent for the first 4 years, and that's a kilo. And again, we referenced 350 grams a ton being top 20 in the world. Keep going below there, you'll see that the average production for the first 4 years is just under 14 million ounces a year of silver equivalent at less than $5 an ounce. So at that commodity price and at that run rate, you get 135 million of after-tax free cash flow. So that's more than a 10% free cash flow yield with today's market cap. And again, that's at $19 silver. So again, the average free cash flow yield for the peers today is probably in the 5 to 8% range. So again, even at lower prices, we're fine. But again, this is a study that was done 18 months ago. We've made some very serious discoveries, very significant discoveries since then that will be included in the feasibility study and will allow us to hopefully optimize the numbers you're seeing here. And this is the production profile. And again, I'll highlight that post-production at Santa Elena, we grew the resources 300%. So the numbers you're seeing here, again, are very much in the early days, only 10 of 43 veins, none of the deeper deposit, and none of the new property. Just quickly to reference before we get to the fund growth part of the story, is just going back to the costs in the industry. One of the things we're trying to highlight is if gold and silver do not perform well, our margins, or potential margins, should hold up very, very well compared to our peer group. You can see the red dotted line there showing that only 6% of all silver producers have an AISC, and that's an all-in sustaining cost less than $6 an ounce. So again, that's our drilling plus our theoretical or potential cost to pull it out of the ground. So again, very, very robust defense. And then let's get to some offense. We like to use this slide called healthy leverage. Quite often when people who play the commodity market like to know what happens to the valuation of a company if the commodity price moves higher. And that's great, but it also works what happens if things move lower. So as you can see from these numbers here, even that downside scenario here in the sort of the silver to light blue number on the left, even if you use $1,100 gold and $14 silver, the IRR on the project was still 64%, and the payback period of the upfront capital was still under 1 year. Now, again, the number used was 100 million in that PEA, and we referenced a number closer to 130, 140. So there is a slight change just to make sure everyone's aware. Now, the offense, the fun part. I haven't confirmed this, but we did have the second largest drill program in North America. I think it's the same, but don't hold me to that. The second line you'll see in the offense category halfway down, we have drilled 400,000 meters to date, and that's since we started the company, right? And that's 2016. In 2016, we only had one drill rig. So that's a big amount. We've been very aggressive. But the budget that I explained earlier is hopefully going to give us the financial and operational capacity to equal that number of meters drilled by the time we exit construction. So part of the story, again, is to re-rate to cash flow, hopefully have a nice free cash flow number, which usually when a lot of people enter new stories, but at the same time, growth. So again, as you can see here, we got the 8 drill rigs turning. Everyone's living in a quarantine camp right now. The main things that we are going to be going after is Bobby Vista, and that's bullet number 4. And let me put that in context for everybody. We only have drilled 800 meters of what we believe to be a known 2 kilometers of this particular vein for the feasibility study. Hopefully by the end of Q1 or H1, we've drilled another 1.2 kilometers. There's a good chance that this vein is over 2 to potentially 2.5 kilos on a cut and diluted basis within our feasibility study, to be determined, we'll see. But to remind people, that's more than double the average grade in our first 4-year production scenario for that PEA. So if we're able to put more of that material in the first few years and remove some of the lower grade material, there's a chance that the average grade that we're producing from goes up, which means the average number of ounces produced goes up, and it should mean that your costs go down. Again, to be determined, but This is very significant. If we are able to find more ounces in this particular area, even if it's something as simple as 300,000 tons, for us, we need 450,000 tons to fill our proposed mill on an annual basis. But if you can find 300,000 tons at that kind of grade, it might contain in the neighborhood of 15 million ounces, but it is in something that might be half of 1 year's potential throughput. So again, the significance to the free cash flow, to the NPV, and the valuation is quite significant. So that's something that we hope to have more information out in the next 6 to 9 months. And again, long before we actually get into production. So the numbers that we'll talk about in the feasibility study could be dramatically different from what we actually produce in the second half or Q3, Q4 of 2022, which is what we hope to be the first production. Bullet number 5 here is El Muerto. This is a new area. We have not drilled to depth in any of our public news releases so far. We've been focusing on the near surface, low-hanging fruit, things that we have a high degree of visibility on, so that we are very efficient with our capital and the shareholders' capital. But now we're starting to have some excitement around the deep zone. It's too early to say. None of this will be included in the feasibility study. But if we are successful in this area, it does open up the potential that some of the veins, hopefully all, would have a parallel zone to depth that could provide additional ounces and tonnage. One significant thing that we haven't talked about yet is, yes, we're going to have a 1,250 ton per day mill that requires 450,000 tons a year to fill it. We are permitted for 3,000 tons a day. And the way that we're building the mill is that scaling from 1,250 tons a day to 1,750 or 2,000 should be able to done with very, very, very modest capital. What we don't have enough of today is tonnage. So again, if we're able to find significantly more, we have the potential to ramp this up to 1,500 tons a day, 1,750, or fingers crossed, maybe more. So that not only decreases your costs as you add economies of scale, but the production profile has the chance to go up significantly if we have that sort of success. So again, a deeper zone could open up the idea of more tons. This is what we call the treasure map. The purple spheres here are the 3 main targets that we've been working on lately, and the one on the left in the Las Chispas area. Again, significant target for us. Not necessarily going to be part of the first few years of the mine plan, so a little bit on the back burner. All of our drilling focus is going to be on tons and ounces that we can continue to optimize the first few years and really accentuate that NPV. One thing quickly to note, most of these veins are about 150 meters apart, so the underground development and the time to get to them is very quick. Probably in the neighborhood of $1 million of underground development to develop towards the other additional veins. This is just a quick snapshot of just the site. We talked about the de-risking of having stockpiles already there. We hope to have approximately 6 to 7 months of ore sitting on the surface before we start the mill. I did reference about 30 million of working capital that we would want to have in case the mill started off slowly or there were some challenges. This is in addition to that stockpile. That stockpile is also going to hopefully serve a similar function. So here's what I call Eric's new toy. And this is what's called El Picacho. It's an asset that we just purchased for $2.1 million. It's in line with Eric's previous purchases. Santa Elena was about $5 million. Las Chispas was about $5 million. So it fits into that category of healthy leverage. We don't break the bank with our purchases, but if we can add significant value via exploration and then operational synergies, again, this is the best bang for the buck for shareholders. So again, 85 kilometers away, this was a past producing mine. The people that have drilled this historically had a different geological interpretation, but for what Eric and the team have learned from Santa Elena and Las Chispas, and if you apply that geological interpretation here, you get a whole new set of targets to go after. Above and beyond that, you'll see that we have 7 known vein systems on the project, and that's, I want to underline the word so far. And also, the main vein there is called El Picacho. It's got a 4x4 decline currently in place. it's about 4 meters wide. And that's significantly more with some of our high-grade veins that we have at Las Chispas. And that means we have a greater potential for more tons. And again, more tons for us is more mine life and potentially a throughput expansion scenario we can work with. Don't have, permits we're working on. We hope to have those in place in Q1. There's some twinning of some historic holes we can do that hopefully can add to some very quick tons and ounces. And again, with our mine life that we have today and production profile, every 1 million tons could be 2 years of mine life, or it gives us the ability to potentially sequence more ore up front. So for example, 1 million tons could also be an additional 250 tons per day for 10 years. So again, it gives you that scenario of that healthy leverage where we can increase that throughput if the scenario plays out like we hope it will. So we are just trying to get on property right now, trying to get moving on that. And hopefully that's a 2021 story. So again, just to give people that comfort of where we're at on the base case, Eric's built 6 mines. Hopefully this is number 7. Pierre has built the largest gold mine in Canada. We have a project that has one of the lowest, potentially lowest cost profiles in the industry with one of the highest margins out there. So we don't rely on the commodity price to get a significant return. If we're able to front end load that new economic study where instead of 14 million ounces a year, we can inch that up to 15 or 16 at $5 per ounce on paper so far. People at home can sort of do their own math and gauge 15, 16 million ounces a year at $5 costs. Today, that's about $18 margins, right? So you get a sense of what that free cash flow profile would look like. Again, our permits are in hand. The underground development's well underway. The stockpiles are there. Detailed engineering is far more advanced than a project would normally be at this stage. And then I also like to talk about what could go wrong. We are building a fully quarantined camp for COVID. We paid everybody full wages when there was a shutdown. Mexico has deemed mining as essential. So again, it's the jobs and the communities that people are needing. So again, that's a problem though. So again, don't underestimate that. The feasibility study, converting the resources to reserves, we're working on that. People will have more detail on that in December. The financing we talked about, hopefully that's something we can work our way through. And we'll always mention political risk. I mean, Mexico, one of the highest wage industries in the country is mining. And you think that if countries are struggling for revenue these days, that any industry that's doing well, which is gold and silver, and money flowing into the country would be something that the government would be celebrating and supporting. But we do like to mention that. So again, catalysts, more and more drilling. You're going to see more drilling nonstop from us. And again, the 8 rigs are on that main Bobby Vista vein, which is, hopefully going to pack a big punch for us. And then the underground part of the property, which again could be very significant for us in terms of resource growth, optimization of the mine plan, increasing throughput and mine life. Again, very significant part of the story. End of year, you'll see that feasibility study. And then early in the new year, we'll try to finish up the financing solution. We want to de-risk as soon as we can. And that construction decision, we're already more or less moving on the mine portion of that. We have not made a formal decision on the mill. But again, with the economics here, we're charging ahead. And then for next year, again, we're working on doubling the number of meters drilled between now and the end of construction. That's hopefully a gift for the shareholders, why you'd want to hold it through construction, not only for the re-rate, but on the potential of adding, 20, 40, 60, 80 million ounces between now and in the next 2 years could have a very significant potential on the NAV and the mine plan, and whether or not the M&A thesis is something people are looking towards. I don't think too many people are excited about taking a run at us prior to construction so they can take on the build thing, but I think it's something that we want to highlight as we exit construction. That's something that could be an added catalyst for investors. So I look forward to be around for the question and answer period for the conference, and we thank everyone for taking the time today.
And there he is. Chris Ritchie is now joining us live. Welcome.
Thank you.
You mentioned, well, it's not the most happy subject to talk about, but after you talked a bit about COVID-19, because Mexico has also been quite dramatically affected by the pandemic. You mentioned these quarantine camps. How severe is this? Was the impact on your operations?
To the operations, so far, the impact has been to slow things down, obviously, for a few months. We're very sensitive to the communities and making sure they benefit economically from having us involved. As people might or might not be aware, there is a EBITDA royalty tax that's charged to all mines, and all that money flows to the federal government, not the state, not the local governments. So part of the comment about me mentioning that the mining companies the communities need us there, we're the only source of economic impact. Mm-hmm. So for us, we've been providing the medical services, food for people that are struggling in the local community. There's the only economic support that is there is largely from the companies that are operating in these places.
Mm-hmm. A follow-up question on that, Heider. I recently read some report that the social and economic situation in Mexico is deteriorating quite a bit because of this crisis. Can you confirm that?
About 50% of the population live below the poverty line. I'm very comfortably positioned here in Canada right now, where we have a really, really strong social safety net, and Mexico doesn't have that same social safety net. So again, there is more of a need for some external industries to come in, for foreign capital to come and help provide infrastructure the government's not necessarily in a position to do so with. Right now, also in Mexico, about 50% of the COVID tests are turning around in positive results. So that tells you that there's dramatic under-testing right now, right? So, yeah, we're not through this challenge by any stretch down there. So, I mean, for example, tourism. I mean, the huge boon for the Mexican economy is not going to be very healthy, I would think, for quite some time. So, again, my comment in the presentation about needing strong industries that are bringing in foreign capital, that are paying tax dollars, there is a thesis, but it requires logic, and logic and governments don't always go hand in hand. But it would be that they'd be supportive of mining. And again, they did deem mining as essential. So they're actually pushing companies to move forward.
And the effects on world silver production are quite severe. I recently saw research reports pointing to a drop of 16 to 18% in world silver production this year. Is that right?
Yeah, I've seen similar numbers. And I mean, you can push it even further and say, the downturn in prices pre-COVID, we had a huge 10-year hangover from the global financial crisis. And on average, it takes about 8 to 10 years to bring a new mine online. So prior to COVID, you had a real long period of time with lack of investment. And only now where you're starting to see monies flow into company coffers to allow for more drilling. So there's going to be a really big lag before you start to get any supply response to your comment about lower demand or lower supply, even on the production basis today.
Could that lead to some serious, production deficits and maybe some stress in the physical silver markets?
Yeah, I mean, gold and silver only make up 0.5% of global AUM. So roughly the total amount of supply per year is around, 1 billion ounces. So at, $25 silver, it doesn't take much money to be soaking up, 20, 30% of the annual supply. So small changes to the fund flow can have a really big dramatic amount. And you've seen that already this year. And at the same time, yes, you are seeing, large curtailment in production at the very same time. So yeah, both sides of that coin point to further upside.
But that makes your company, of course, quite valuable from an M&A point of view, because there are very, very few companies like yourself in which, a producer can buy into a large new silver discovery and a lot of upside potential.
I referenced as well, every company right now is having their challenges and headaches with their own operations. The producers are certainly, feeling the brunt of that. But yeah, we're kind of glad for those challenges to our peers, because that gives us more time to drill, right? For us, like I said, for every dollar we've spent, we've added about $9 of value. So for us, we want to position ourselves and de-risk the company and really focus on that free cash flow number. Because again, if you look at the free cash flow yield of our peer group, there's a pretty robust re-rate that could happen at that time. So that re-rate is probably a moment in time where people might look at us and say, you've handled the build, you've navigated the risks. It's a much easier conversation, exiting construction. So we're going to make use of that time as well as we can.
Yeah, when I look at your graph of the last 5 years, SilverCrest seen an increase of in the share price of over 6,000%. That's an amazing result. How much upside is there still left?
Well, in that PEA scenario, we had roughly 14 million ounces per year in the first 4 years. And that was, each year for us is roughly 450,000 tons. So again, for us, it's not a lot of tons to get a year. So if we can find another 2, 3, 4 million tons, that either improves that mine life, or if we are able to go from 1,250 to 1,500, 1,750, we're moving all that production to the front end of that mine life. So, when you're finding 3, 4, 5 kilo material, it doesn't take much of that to really move the needle significantly.
So you hope to stay independent and become a producer yourself, or you expect to be taken over before the production starts?
Yeah, there's probably a very small window at which we'd be willing to have a conversation, and that window's shutting pretty quickly. Because we have a team that is capable of building, and there's still so much more of the property to drill off, we want that opportunity. So we're quite happy to be drilling and then get it to production. And if someone wants to talk to us at that point, we're going to be happy to have a chat then.
Thank you.
Okay, we'll have to leave it here. Thank you, Mr. Ritchie, for your time. Chris Ritchie,
Thanks
President of SilverCrest Metals. Thank you.